Okay, today we're going to be going over the options trading Greeks. Today I'm using Robinhood because it kind of just simplifies things, and I think I don't want to show too much information from my TD Ameritrade account. Today we're going to go over Delta, Gamma, Vega, and Rho. Kind of some of the key kind of options. I have a position on for an Iron Condor is kind of like a common trading strategy, so I'll kind of go over that as well, and kind of how I'm managing that. Um, One of the key, let's get to it. One of the key Greeks in options trading is delta. You kind of want to know before you even kind of like dip your toe into it. Understanding the Greeks is very key, and it's one of the things that was very hard to kind of find a clear and kind of coherent way of someone explaining it. So just all the ways were pretty like impractical of how people were explaining it online, Tasty Trade, and all these different sites, Option Alpha. It was pretty hard to get kind of like a clear and consistent basis of it. So right here we have an options chain. We have all the different things. So for calls basically being set, we have all these different strike prices, and then we have the prices of the contract. These are all multiplied by 100. Everything in options is multiplied by 100, and then you can kind of go into it. So even looking at this one, delta is the how the contract changes based on a movement in the underlying price. So yeah, as you kind of know, it definitely can get amplified up, but delta is a very, very basic thing of telling how this option moves and how it goes up and down, how this contract goes up and down in value, and how it increases and decreases with this underlying stock. So say GM does like poorly in like an earnings report, doesn't sell too many cars, this SPY number will go down. This delta then will kick this option contract down $49 basically. Delta is a way that shows how much, yeah, the contract is up and down, but in another practical way as well. Um, I've been using these for somewhat a couple of years now, and I kind of just have it more simplified down to how to use them practically, not the full definitions. Um, Another way of using delta is it's a very key way of saying kind of how TCJ described it, of showing how things are in the money risk is almost like a percentages of going out. The correlation isn't fully there, but it is somewhat of a good way to show okay what is the chance that something is going to be in the money or kind of go down in value or not like have any value at the end. So delta right here is 40 on this. So every underlying change in SPY, it drags down this contract $40. So something like that, though, I'd want to see if how much money I want to make. So say I want to buy a long call, so different options trading strategies. Say I know SPY is going to go up maybe in 10, no, it wouldn't be 10 days, 30 days. You want to give yourself enough time out. Say I know SPY is going to go up, which it probably will. If I can afford this contract, which is $1,100, I'd want to buy a high delta. This delta basically means I make $51 every time SPY takes up. So it's really a way to kind of like use this Greek and say, wow, I can make so much like money based on just SPY going up one tick, like at all. It's a really kind of cool way. Gamma, how it been, is showing how much delta will change based on kind of just like movements in the underlying, how much delta will change or how much delta like kind of kicks up and increases. But the more practical way that I've been using it is it's more of a sign for risk, basically showing like, okay, how much is delta going to move with these underlying changes in the price. So it's really a way to look at it as saying, all right, if delta gets up to maybe like 0.04 or maybe a zero point 0.1, that's a very like high kind of risk that I really wouldn't feel like as comfortable as seeing that, because that means this delta is going to go up or down drastically. That means things are really going to vary with this option contract price, and so it may lose like all its value very quickly. You do want to monitor gamma and kind of watch that. Theta is how much the option contract decays by the rate of time just over the day. So theta with this basically shows deterioration. So when you're selling option contracts, it shows basically how much money you can make as every day goes by. So this in this instance right here, this option contract loses $25 a day. So there's always a fight between theta and delta of seeing how much this contract will go up by. So one tick up in one tick up in SPY in one day is $51, but you're also losing $25 to that day. So it's something really to watch. Vega is the Greek that represents how the volatility impacts the option contract. So how this implied volatility here goes up, it represents how much the option contract will change from this IV going up. So this is also something to kind of monitor as well. I haven't monitored that much, and maybe that's why I'm not the best at trading options, but this 78.2 is something to kind of watch and kind of monitor because this IV, the implied volatility is just how much the option contract will go up and down kind of in value. And or no, the implied volatility is how much the SPY will go up and down in value. So it is something to kind of monitor as well. Rho is how much this option contract will change based on movements in the Fed interest changing rate. So this is something more now to watch. It used to be something you really didn't care about, but you can kind of look onto it a little bit, but it hasn't been something too much. Maybe $26 a change if the interest rate goes up like a 25% or a 25 basis point like raise by like June. This could impact the contract, but you're mainly really looking at delta and gamma as something in a practical way of to what to monitor in the Greeks. I'll go to my current kind of contract and just kind of show you how I'm kind of monitoring my one position, and you can kind of see like some base values of kind of how much things will kick up and down in value. So at 331, I threw an iron condor, so you can kind of see it will have some shakes. It will go up and down. This means it kind of went against you. SPY went up a little bit, kind of almost breached, and then it got back to normal. And it expires Monday. I think all this will be a successful position, but I'll just kind of show you some of the positions I had on and kind of like the Greeks that I monitor while I put that iron condor on. I'm gonna make $22 from that iron condor in just like 2 or 3 days, and I just like basically sit it on and just let it sit, and it's easy like $23. So it's pretty easy rinse and repeat strategy. It's just a little risky, so I kind of have to watch how many of these I do. But it's a way to make money very quickly. So with this contract right here, I think I set out the days. I think I set out the expiration just a couple of days. But with this, I originally sold the call at a 15 delta. A 15 delta is a 1 standard deviation removal. So basically, it's saying SPY won't jump more than 1 deviation, or basically there's 85% that SPY won't get past this strike right here. So whenever I'm like looking to put on like an option trading strategy, I'll go in, I'll check the delta, and a 14 delta or 15 delta, I'm like, that's excellent. I know there's a really high percent chance that this strike will not be breached and I won't lose, I guess, the $100 kind of that I put down. This gamma looks pretty low. Theta, this is basically how much, if you're selling a complex contract or more of like an iron condor, it doesn't fully like balance out. Whenever you're just straight selling only a call, this theta would be something to look at a lot more. When you're buying it, it's more to look at. But overall, when you're doing something like an iron condor, which is you sell the call and then you buy the call, and then that gives you a credit of about $10, and then a put, you sell a put and then you buy the put on the lower end. And so clearly these are going to expire untouched, so I'm excited about that. And you can kind of see it's now a 4 delta, and then this buy the put is also very low delta. So that means a high chance of this will do well. Iron condors are a very good way in like a low IV environment to make money. Basically, it just kind of puts these kind of like reins on the stock or ETF, and then you there's a high chance that it just kind of times out and you make your money. It's hard. It's really a hard concept. I'll probably keep going more into it because I remember when I was trying to learn, it just seemed impossible and very risky. But iron condors are mainly a key way you can kind of make money in options, and it's one of the high percentage probability strategies, and something to kind of like really look into and like use if you want to kind of trade more options. That's a bit of a rundown kind of like how the Greeks work and kind of like a more practical way. I'll probably keep going into more things.